Welcome, curious minds. We're diving deep today into something often called the language of business.
Accounting principles.
Exactly. And like any language, you really need to get the basic words and grammar down to make sense of it all.
Absolutely. So our mission today is really to decode that language for you. We want to turn these concepts, which can seem dense, into clear insights.
Give you a shortcut, maybe, to being truly well-informed.
That's the idea.
Okay, so let's unpack some of that essential vocabulary. First up, the entity concept.
Right. So when we talk about a business, say Kana Jewelers, accounting sees it as completely separate.
Separate from the owner.
Totally separate. Your personal finances, the owner's finances, are distinct from the business's. It's crucial for clear reporting.
Okay, and within that entity, things happen. We have events and transactions.
An event is broader, anything changing the financial position, but a transaction, that's specific. It involves an exchange of value.
Like buying goods.
Precisely. And speaking of goods, that term itself is specific in accounting.
How so?
Well, if you sell fans, fans are your goods. Your office desk isn't. But if you're a furniture dealer...
Then the desk is goods. Okay, it's about what the business actually trades in.
Exactly, what it deals in for sale.
Which brings us to the core components, right? Assets, liabilities, and capital.
The big three. Assets are what the business owns things with value.
Liabilities are what it owes to outsiders, banks, suppliers.
Right, and capital is what the owner has put in, their investment.
Now here's something that trips people up sometimes. Why is capital, the owner's money, treated as a liability by the business?
Good question. It comes back to that separate entity idea. From the business's perspective, it owes that invested amount back to the owner.
So it's an internal obligation in a way.
You could think of it like that. It enforces discipline. It leads directly to the fundamental accounting equation.
Assets, capital plus liabilities.
Always. It must balance. Think of Mr. Guyan Chance starting his business. The cash he puts in, an asset, equals his capital, a liability on the business's books.
Okay, so those are the key words. Now, how do we make sure everyone uses this language consistently? We need rules.
We do. The generally accepted accounting principles, or GAAP, these aren't just suggestions, they're the foundational ideas.
The grammar, sticking with our language analogy.
Pretty much. And some rules are quite revealing. Take the money measurement concept.
This one's interesting. Only things you can measure in money get recorded.
Exactly. Think about losing a brilliant, highly efficient manager. Devastating for the business, right?
Absolutely.
But you can't precisely measure that loss in dollars or pounds, so it doesn't get recorded in the financial statements.
That highlights what accounting doesn't capture, too.
It does. Intangibles like morale or brand reputation often aren't directly on the books.
Okay, what about the dual aspect concept? You mentioned every transaction has two sides.
This is the bedrock. Honestly, it's the engine of the whole system, the double entry system.
So gives an example. Buying a machine.
Perfect. The business gets an asset, the machine, so assets go up.
Good.
But it probably paid cash, right? So another asset, cash, goes down.
Or maybe it bought it on credit.
Good point. Then the asset machine goes up, and a liability, say accounts payable, also goes up. Two sides every time.
And that keeps the main equation, assets, capital plus liabilities, in balance.
Always. It mathematically has to.
Now, related to assets, how are they valued? Does it change if the market value goes up?
Generally, no. That's the cost concept. Assets are recorded at their original purchase price.
So that delivery van we bought for $50,000, even if it's worth $55,000 next week.
It stays on the books initially at $50,000. Then, over its useful life, say 10 years, will reduce its value systematically through depreciation.
Based on that original cost.
Based on the original cost. It provides objectivity. Market values can fluctuate wildly.
Another one I find key is the matching concept. It's about linking revenues and expenses, right? But not just based on cash.
Exactly. To find the true profit for a period, say a month, you need to match the revenues earned in that month with the expenses incurred to generate those specific revenues, regardless of when the cash actually moved.
So if I pay my annual insurance premium in January,
only 1/12 of that is an expense matched against January's revenue. The rest is prepaid, an asset initially. It ensures a more accurate picture of profitability period by period.
And then there's a cautious approach, the conservatism concept.
Yes, prudence is key here. The idea is anticipate no profits, but provide for all possible losses.
How does that play out?
A common example is valuing inventory, the closing stock. You value it at whichever is lower. What you paid for it, cost or what it's currently worth in the market.
So you don't overstate your assets if prices have fallen.
Precisely. Don't count your chickens before they hatch, essentially.
Okay, finally, let's touch on materiality. It seems like a practical filter.
It is. While another principle, full disclosure, says you should disclose all relevant info, materiality adds common sense. Meaning, you don't need to track every single pencil or paperclip as a long-term asset and depreciate it over years. The cost and effort outweigh the benefit.
Its impact isn't material enough to influence someone reading the financial statements.
Exactly. Focus on what actually matters for decision-making.
So, pulling this all together, understanding these terms and principles, it's not just for accountants, is it?
Not at all. It's about understanding the pulse of any business, how it manages what it owns, what it owes.
It lets you see beyond just the headlines or the surface numbers.
Absolutely. You've got a foundational grasp now of this language of business.
So the next time you hear about a company's performance, maybe think about these concepts. Consider the entity separation, the dual aspect, the matching.
Yeah.
How do these invisible rules shape the financial picture you're seeing? And how might understanding them better change how you evaluate a business opportunity or risk?